do feel that we are reasonably close to the terminal rate, which we would put at 4.75 to 5%. We think there will be another couple of 25 basis point hikes in the first or second quarter of this year, but I suspect that rates will remain elevated thereafter. If there was to be a pivot, it would probably be in the fourth quarter of this year, more likely in the first quarter of next year, because my sense is the Fed remain committed meaningfully to ensuring inflation is well under control, and I don't think that's going to be likely, particularly from a core perspective, until the second half of this year. So I disagree with this concept or idea that there will be a rapid pivot anytime soon. I think inflation will remain elevated, and I think interest rates will remain elevated.
Let's turn our attention to equities then. There's also optimism in the equity markets, isn't there? The S&P earnings forecasts are still remarkably robust in a context where we're expecting a recession to come through.
I'm not entirely sure we are expecting a recession with any meaningful probability. I mean, Credit Suisse is forecasting something close to a 40% probability of a recession. Maybe the market is closer to 50-55% probability. And certainly, as you correctly point out, the S&P is not priced for recession. Investment grade credit is not priced for recession. More a deceleration in growth, possibly a serious deceleration in growth to sub 1%. And I would agree that when you are at that sort of trajectory, a broad recession is possible. But right now, unemployment is extremely low. Household balance sheets, in an absolute sense, are extremely high. Corporates are not particularly leveraged. And in those circumstances, it's hard to anticipate a recession, certainly developing in the first half of this year. And I think it would be a bit of a struggle even into the second half. 2024, I'm not so certain. But my sense is, for the first 6 months, highly unlikely.